Well, okay,
not.
now you got a couple more that you're building out. So this financing thing I think is very important for people to understand because most people do not understand financing at all. Are you going to be able to do the same time of financing with these other properties that you're building out? Or okay, so how are you financing these new projects that you're going to build out and you're going to have as short-term rentals?
So Ricky and I, like say the two projects that we're buying, we use private money or hard money for those acquisitions on those things. And specifically, he's kind of a hybrid quasi hard money lender that we use. The rates are anywhere from 10 to 11%. That you on the initial purchase. So we do that, and then we put our own cash into it, and then we take it and we'll refinance it out as an investment property. But we're building that 25% equity window into the property that we need in order to get it refinanced out, including get most of our cash into it out. So that's kind of like that.
So it's kind of like that BRRRR method, right?
Yeah. It's like a BRRRR method, but you're using it for an Airbnb, and it works for anything. It's just your end goal. You just have to decide what it is. We look at everything. It could be a single family rental that we want to just make a single family rental and do the exact same strategy. But, in certain locations, the profits can be really huge in Airbnb. So it's like, what is the right thing for this property? And you're just clicking through the gears, trying to figure it out. And it's like, it just so happens, our downtown property, it'd be a great single family rental for sure, but it would be a phenomenal short-term rental, like 2 to 3 times what, you could possibly get from a regular rental.
Okay, Bob, so let's clear this up now. All right, so you're going to go out and you initially acquire this property using hard money. You have a 10% rate. You have to put some money down, obviously. You're going to fix it up. Now it's worth more money because you got a new appraisal. Now you go refi it. Now, when you refi it, are you refining it back with the hard money lender, or are you going to a conventional bank, or who are you refining that thing with?
That's a good question. This was a struggle that we had over the last year and a half for my brother and I. It was really hard for us to acquire and hold properties because we didn't find the right lenders. So that's another great list that we can provide to people is off-market lenders that don't go with the conventional standards, of lending. And we've got a handful of them. Every time we see them now, we just put them down and we hold them and we have them. And right now, we have one that we're really working with that we've got, that we just refinanced one property through, which went really smoothly. Don't you think, Ricky? Went
smooth.
It went smooth with them. And so that's probably the biggest thing. And what these type of investment lenders do is they understand that there's investors out there that can't use the conventional world. And really quickly, if you live in an area with high price houses, your debt to income ratios get crushed really quick when you got a couple of properties. So you end up having to figure out that route very quickly. And that's just something that we both focused on. We're like, we got to figure this out. We got to be holding more than we're selling, because we're just selling. And it's like, we're making cash, we're paying taxes, but we want to hold, we're investors for the long term. So this is just part of our strategy.
Okay. So that really gives me a good feeling of how you're pulling this off from a financing perspective, because everybody, number one thing you have to figure out is the money. You have to figure out how you're going to finance these things,
on multiple
how you're going to
levels.
hold on to them, how you're going to leverage them, because the leverage in real estate is the value of real estate. Yeah, everybody thinks the asset's great, and it is great. You get appreciation, you get cash flow, but the beauty of it is the leverage that you get. You get leverage because a bank will give you 80% of the value of the property. They'll loan it to you, so you only have to come up with 20% of that. The leverage is all the tax leverages and the tax benefits you're getting from these properties. So the leverage you get in the financing, you have to understand the financing.